Today we're joined by Laura Dietzl of RSM, Derrick McGavic of Newport Capital Partners, and Preston Sargent of Bailard. Welcome everyone to PrivCap today. Thanks for being here.
Thank you so much.
Thanks for having us.
Let's talk a bit about the gateway cities, New York, San Francisco, the cities that take up the lion's share of institutional capital, and you have capital from all over the world going there, presumably to find safe places to park and to stay for the long term. What are the challenges of investing in those gateway cities? And a lot of people go there because they perceive the risks to be lower.
The irony is that the reason that people go to those CBDs, the central business districts, is because they are perceived, just as exactly as you said, they're perceived as lower risk, and they have more liquidity. And both of those things drive because of the number of investors that want to be there, there's greater liquidity. And that's true until it's not. And it's been very true the last 7, 8, 9 years. And so they've continued, it's sort of continued to feed on itself, and it's a wonderful sort of virtuous cycle of attracting investors, and more pile in. And people are paying extremely low cap rates, historically low cap rates, historically high prices per square foot, and big premiums to replacement cost. And for us, replacement cost is an extraordinarily important sort of metric and benchmark. And if we can go to West Suburban Washington, D.C., or some of the collar counties in the tri-state area here in New York, and find properties at substantial discounts to replacement cost, and at cap rates that are 200, 300, 400 basis points higher than we would buy a good quality property in the central business district. For us, that's a much better that's a much better bet than trying to frankly fight our way into some of the wonderful gateway markets that for us have just gotten too expensive.
Unfortunately, not enough real estate practitioners really understand the word liquidity. Liquidity, all that means is money can come in and it can go out, and it's easy and frictionless to go. It's the availability of money, or the lack thereof. So, you're an acquisitions officer. You're tasked to put money out on behalf of your clients, and Southern Florida is your region. $50 million property comes on the market, and there's 30 plus funds chasing it. Well, that means $1.5 billion is trying to buy that property. Nobody's any really smarter than the other. So it's not that there's liquidity going to buy that property. There's a lot of money going to buy that property. It's supply demand. There's a lot of supply, there's little demand. Guess what? Price goes up, cap rates go down. So for our world, would I rather compete against $1.5 billion for a $50 million deal, or would I rather compete against $150 million? Guess what? That's still an ample amount of money. There's 3 bidders. It's an active market. It may not be as active as Southern Florida, but guess what? At some point, instead of 30-some bidders going after the deal in Southern Florida, it'll be 2009, and there'll be nobody.
Yeah, and as you're looking at those gateway cities, you're also competing with global investors who have very different risk profiles than traditional U.S. investors. So if I'm an investor and I'm just looking for a safe haven for my money, I don't care if I have a 3 cap. But that's very different. I may overpay for an asset easily just to park my money there safely. So we really have to think about those gateway cities, New York, San Francisco, D.C., that attract all that global investment money, as having different risk profiles for those investors as well.
You're exactly right, Laura, and it's different return profiles as well. When your alternative investment and you're a European investor is German bunds, which are paying 0.
Negative. Sure, right, there's negative.
Even if you buy something at a 2.5% or 3% cap, you feel like you've hit the jackpot.
Even in political uncertainty, I mean, the U.S. remains a safe haven for real estate investment.
Well, let's talk about the traditional perception of risk in real estate among institutional investors. Are some of these investors perhaps overstating or underestimating risk in various settings? So, for example, the traditional image of risk in the gateway cities is, well, maybe you're overpaying for something, but at least in a recession or some distressed situation, buyers are still going to be there. The impression of buying real estate in sort of second tier or further flung areas is that maybe not as many people showed up to buy a property on the buy, but if the deal gets hair on it, or if we hit a recession, there might be no buyers for your property and you have a liquidity crisis. Is that overstated?
I think that's how it's perceived, but I think the risk is really on its head, so to speak. The real risk of real estate isn't whether there's somebody going to be there on the buy side when you want to sell it. The real risk in real estate is somebody going to pay you the rent when the first of the month comes around and you can get your cash flow. I think fundamentally the biggest risk that gets overstated by investors who are trying to go to gateway cities is, in order to make sense of their numbers, they have to project out growth rates in their rental rate assumptions that frankly may not be sustainable given the life cycle of the tenants in that market. So for us, it's really a much more granular understanding of what's going on in the tenant world.
Sure, and I think you can't let your underwriting standards get away from you, especially later on in the cycle. You still need to remain disciplined even though you're chasing yield. So if you're long on a city, you're going to be long because of the job growth potential, because of the universities and that talent pool that's there that you can draw from. So certainly I think it's all about managing the downside risk at this point in the cycle and really understanding that you could have a long-term relationship with the area that you're getting into as an investor.